Welcome back to 9:30. My name is Robin, and today I'll discuss Alibaba. So most of you probably know Baba. It's a Chinese company, and it has multiple services, payment services, but also platforms which serve as a marketplace for both B2B and B2C. Um, and yeah, they've been in the news recently because they are going ahead with their plans to list some of their business parts on the Hong Kong Stock Exchange, and this one being Logistics. Um, so yeah, in this video we'll cover the news, what this might do to the stock price. We'll go over their fundamentals and we'll go over their valuation. Um, and again, please read the disclaimer. Um, this is not financial advice, but it might give you an indication of, um, yeah, might be a starting point for your own due diligence, let's say. So as we can see on CNN, uh, yeah, the breakup with their business units would offer flexibility and would have a beneficial effect both on the company IPOing for their flexibility, so they can raise their own capital, but for Baba itself as well, they will keep the majority shares, and so whenever the valuation for the company is growing, so will yeah the finances for Baba when it comes to their investment portfolio basically. So that might be positive, and they also have been going over, or at least they will try. I believe they have 5 other companies that they want to IPO. So how do their fundamentals look, and is it something interesting to buy in? With our sheet, you'll immediately be greeted with with the company description. So what do they do? A bit of an overview. As I said, they have a lot of things going on in their portfolio, so ranging from, like I said, like marketplaces to financial services. Um, so here we can see some statistics, for example, their market caps, whether or not they pay dividends, earnings per shares, that kind of good stuff. If you have your own ideas on how these numbers would look for you to buy into, this is your first stop basically. When we look at the revenue growth, when we look at their foundations, we can see it's pretty strong. So they have been growing their revenue, although they haven't been growing their net income in the past 5 years. Their free cash flow has been growing significantly, which is really nice to see. Their long-term debt is covered by their free cash flow, which basically means that whenever it's necessary to dump their debt, they'll be able to do so. They haven't been buying back shares. They have actually been diluting the shareholders, which might be a red flag, but it's not as big of a number as we've seen before. And they haven't got any dividends, which is something you'll see with big tech. So then we'll go over or at least you will agree with the income statement, the cash flow statement, balance sheet. These are the numbers that we look at, but feel free to look at the financial statements yourself and see whether or not it satisfies your criteria for Baba to be a buy or not. If you look at their statistics, you would like to see, for example, net earnings ratio to be above 20%. And besides 2022 and 2023, they've been able to do so. But yeah, they have been struggling a bit with their management and also with their sales numbers in the recent years. And I believe also IPOing, or at least cutting off some of their business units, is one of the strategies to get back in the game. The interest expense ratio is nice and low. It's something you would like to see. I would generally say below 6-7% is really good, and it shows here as well. The research and development ratio is a bit on the high side. So whenever a company has a really good moat or a competitive advantage, you'll see that this is more geared towards 0 because they don't have to research their products. They already have a good product that sells itself, and they don't have to alter it. So, for example, you see a lot with Coca-Cola. They don't have any research and development. They just sell the product. And we can see the same thing with their selling and general expense ratio. So these are also a bit on the high side, basically because they need to market off all those products and all those services that they have. The depreciation, therefore, is also on the high side, and this could be due to their vast majority of businesses that they own. This is reflected in the depreciation and gross profit margin. The free cash flow per share is decent. You want to see this to be as high as possible, and it has been growing as well. So it all seems well on this part. And then these statistics I already covered before, so I won't cover them now, but you can look into them, or you can pause the video here. So for the fund Smith ratios, so the return on capital employed is a bit on the low end. So basically means how well are the managers in converting assets into returns, and that's a bit on the low side. The gross profit margin and operating profit margin we already kind of discussed, but yeah, they seem decent to me. But what's really interesting is their cash conversion, so their ability to actually convert their profits into cold hard cash. And according to Fundsmith, you want to see this above 95%, and except for 2022, it has been well above 95%, and the average is at 104, so that's really good. Then we'll get to the assumptions, and basically we'll check out whether or not you might want to consider investing in it or not. So there are a couple of ways how we can check out whether or not, or at least for how much the company will grow. So we can either check, for example, the average free cash flow growth, and on average it has been growing with 24%, but we can also check what the analysts think. And according to the analyst, let me just quickly pull it up. So here we can see they expect a growth of 1.45% per year, which is kind of harsh, I believe. They expect a 9% increase next year. So let's just say that we take the average. So maybe 15% growth, which is already a lot. So let's just stick to the low side. Let's say this 9%. We can check out their PE ratios using macro trends. And over here we can see that their highest point was 86 or 87, and their lowest point was around like 18. So again, that is 87 and 18. For the required rate of return, I keep this at 12% because you want to have a premium over, for example, an index fund. For example, if you want to invest in the S&P 500, you would expect between a return of 7 to 10%. And because you're stock picking and having increased risk, you want to have a higher required rate of return, and therefore we set this at 12. The discount rate, I put this at 12% as well, just to keep it there. And for the margin of safety, I normally keep this at 20%, but based on your own situation, how risk tolerant you are, what your age is, this can change. Because I'm quite young, I still be able to recoup any losses, so I keep this on the low side. But you might be better off being a bit more, you might want to put this a bit higher, just to be in the safe area, let's say. So for the discounted cash flow formula, you can change this to 2, 5, 10 years, 20 years, 50 years. For now, I'll keep it this at 5 years. You don't really know what's going to change because BABA has such a reach in a diversified portfolio. You don't know what's going to happen and how they're going to react to it. So we'll keep it at 5 years. And then we press the analyze button and we'll see what's happening. Right, so we can actually see that considering the average valuation, you might be able to buy this at fair value. But yeah, with the required rate of return of 12%, you would likely buy this at $73. But then again, you might want to pay a bit more for it if you really like the company and what they do. We can also check real quick when they will be undervalued and when they will be overvalued, considering the assumptions we just put in. So if you go to the valuation tracker, we can see that their current price is $86. They would be undervalued at $68. Their fair value is around $92, and at $150, they are considered to be overvalued. This is according to our assumptions. Again, not financial advice. Please do your own due diligence. But this might be a starting point for your journey to see whether BABA is interesting for you. Alright, so thank you for watching this video. And if you would like to own this sheet yourself and not wait for us to make a new video, you can go to 930.com and you can go to get access today. And here you will be able to buy the sheet. And now we have a promotional offer for the first 15 customers. Get it for €1 or $1. And after that, it will become $15. But it's a flat fee. There's no subscription base. It's just $15 in one go. And you will also receive updates and future implementations that we might do. And this is based on our mission and vision that we want to make value investing accessible for everyone. And that also means keeping our prices low so that everyone can benefit from value investing and the assumption that our sheet makes. Again, thank you, and please feel free to leave a like, leave a comment, and subscribe. And have a nice day.